After studying this module, you shall be able to know the meaning of venture capital, understand the need of venture capital funding, learn about different venture capitalists in India, analyze the difference between venture capital and other sources of funding, evaluate the desirability of venture capital funding. Capital is a limited resource and is required in abundance for various projects and investments in order to generate revenues and create wealth. Broadly speaking, there are two ways of arranging finance for investments. It could either be own sources or borrowed funds. Borrowed funds have been a risky proposition in the sense that repayment is must and regular. Interest is to be paid irrespective of the fact whether the project is generating any revenue or not. This led to a problem that people got reluctant in investing in the large risky projects. There wasn't enough to arrange from own sources and borrowings became very risky. Therefore, the investment in new areas that could lead to the growth and development of a nation in areas where, if successful, there could be immense returns, the investments were hampered. The need was felt to encourage people to come up with investment in these areas where no entrepreneur has ever traded. The need was felt to support entrepreneurs to share the results of some risky investments, whether good or bad, and therefore came the concept of venture capital funding. Venture capital. Growth of venture capital financing in India. Venture capital funding has gained tremendous momentum over the past few years. The concept came into picture in the year 1986-87. Initially, venture capital funding was understood to be the responsibility of developmental financial institutions such as Industrial Development Bank of India, the Technical Development and Information Corporation of India, which is also known as ICICI, Industrial Credit and Investment Corporation of India, and the state financial corporations, SFCs. Thus, the first venture capital funding was provided by IDBI. In the year 1988, the Government of India took a policy initiative and announced some guidelines for venture capital funds, short VCFs. Another fund known as Technology Development Fund was also established. However, a major breakthrough came in venture capital funding when the Security Exchange Board of India, that is SEBI, issued guidelines in the year 1996 for venture capital funds. The guidelines provided that the venture capital fund should be established in the form of trust of the company. This led to the entry of foreign venture capital funds to enter the Indian markets. Thus, with clear regulatory framework and statutory laws, the environment will become more conducive for the growth and implementation of venture capital schemes in India. And there is still much potential for the growth of venture capital companies in India. The venture capital corporation can be in the form of the fund or a company. The funds include TDICI, CanBank and Indus, while the companies include TCBC, CCBC, etc. The difference lies in the fact that the fund is for a specified duration and after that the fund is wound up and the existing balance together with appreciation is distributed among the contributories. Whereas a company is in existence forever until it is legally bound up. Financial institutions and banks that have venture capital funds. The following are some of the prominent venture capital companies and funds in India. Technology Development and Information Company of India, TDICI, Risk Capital and Technology Finance Corporation, RCTFC, 20th Century Venture Capital Corporation, TCBC, Can Bank Venture Capital Fund, CVCF, IL and FS Venture Capital Corporation Limited, that is CCVC. Procedure for applying for venture capital funding. The first step is to send a comprehensive proposal to the venture capitalist. Care should be taken while drafting the proposal. The proposal should contain the following details: a profile of the company, its history, if any, and the associated companies, the details of the promoters and other key managerial persons, if any, the performance of the company in the immediately preceding 3 years, if it is an existing company, a detailed project report, projections of financial statements of next 5 years, including cash inflows and outflows, a report showing the approvals of various authorities and boards such as pollution control boards, details about the treatment and disposal of waste and other effluents that will be generated in the production process, details of utilities that will be required like power, water, fuel, etc. A market feasibility report showing the demand and supply of the product, a detailed strategy on the ways of acquiring a large market share, a complete schedule of the manner in which the project will be implemented. Activities funded by venture capitalist. The main reason for venture capital fund was to provide finance to even those areas which are not proven, which can use new technology to manufacture a new product and at times can be risky. The traditional financing by commercial banks and financial institutions is always in areas where there is safe and established technology. If this pattern continues, there cannot be any development in new areas and innovations would not be encouraged. If investments are required to be made in some risky projects, venture capital is a good means of financing the project. Innovations in technologies needed innovative financing, ergo venture capital, which means high risk, high return investments. In November 1998, the government issued a set of guidelines to promote venture capital investments in new companies. Venture capitalists provide finance in the form of either debt or equity. They also monitor how their investments are doing and after some time take an exit route. The projects that venture capital funds or companies support are generally the ones which involve large risk and are away from the traditional and safe industries. Some of the areas where this kind of funding is provided is software industry, hardware, food products, and diagnostic. There is a high risk and uncertainty, but at the same time, they also provide a promise of high return to the fund. The Government of India is keen on promoting technological developments. Therefore, funding is provided in those areas which are untried and comparatively new. The government, in its effort to reduce dependence on imports, also encourages funding in areas where the imported technology can be adapted to manufacture the same goods indigenously. Mode of financing. The venture capitalists provide finance either in the form of debt or in the form of equity. The debt can further be in the form of conventional loans or maybe in the form of conditional loan. If the money is provided through equity, the maximum amount of equity in percentage form can be 49%. If the loans are conditionals, then they have the feature of equity where the lender is ready to share the risk with the investor. The repayment of the loan is subject to the success of the project, and the return on loan will also vary with the success of the project. Exit route. Once the project is successful and with time it starts generating normal returns, the venture capitalists seek an exit route. It will always be more remunerative for the venture capitalist to invest in newer technologies as they provide premiums in the initial stages. The venture capitalists first offer the promoters to buy their stakes in the business, and if they agree, the shares are sold to the promoters or the repayment is done. However, if the promoters are unwilling to buy the stakes, the venture capitalist shall be free to dispose of their investments in the manner they deem fit. SEBI proposals for venture capital funds. The Security and Exchange Board of India has been the regulatory authority in India for securities market and has set up proposals for the venture capital funds in India. As per SEBI, the venture capitalist should be allowed to invest in unlisted companies and also in SIC companies or potentially SIC units. They should be allowed to invest in turnaround ventures and also in those ventures which are undertaking research. The venture capitalists should not, however, be allowed to invest in non-banking finance companies. The venture capitalist will also be required to comply with the CBDT, Central Board of Direct Taxes guidelines, if it wants to avail itself of tax benefits. Another important aspect that SEBI guidelines have highlighted is that since the investment in venture capital funds are highly risky, therefore only the domestic and offshore institutional investors, high net worth individual and HNIs and corporate bodies should be allowed to invest in venture capital companies. SEBI was also interested that venture capital companies should be within its regulatory framework, and therefore it kept with itself the power to inquire and inspect the funds. SEBI also suggested a two-tiered structure for venture capital funds comprising a trust and an asset management company. The AMCs of venture capital should not be tied to a single fund, but should be allowed to manage the funds of more than one venture capital simultaneously. SEBI also suggested that a venture capital fund should be sufficiently staffed by technical, financial and marketing experts. Difference between venture capital financing and conventional financing. There are major differences in venture capital financing and conventional financing. These can be listed as follows. A venture capitalist is willing to assume risk involved in the project, whereas a conventional provider of finance is interested in keeping his money safe. A venture capitalist plays active role and he may even be involved in the managerial decisions making process, whereas the role of a conventional fund provider is passive. A conventional fund provider may at the most include some restrictive covenants in the loan agreement. A venture capitalist gets payment related to the performance of the project, whereas in conventional financing, it is obligatory to make the payments to the providers of finance irrespective of performance. Venture capital funding is generally in the form of equity or conditional loans, whereas a conventional financing is always in the form of loans. Venture capital investment process. Venture capital investment process is a sequential process which involves 6 basic steps which are as follows. Number 1, deal origination. The very first step in venture capital investment process is the deal origination. A person having a good idea and a project will come up with his neat requirement of funds. Number 2, preliminary screening. The idea will be preliminary screened for its potential and viability, and it would be financed only after preliminary screening. Due diligence process. A due diligence would be undertaken regarding the information submitted and other details provided. Number 4, structuring the deal. After the above processes, the final deal will be structured and the role of venture capitalist, the mode of financing, and the extent of financing will be finalized. Managing the investment and other related activities. After the investment is done, there would be some post-investment activities which should be carefully taken up. Number 6, last, exit. Finally, when the project starts generating normal returns, the venture capitalist will take an exit route and will sell his stakes either to the promoters, and if promoters are not willing to take, then the venture capitalist may dispose of the investments in the manner they find most suitable. Information needed for appraising a project. The following information is required by a venture capitalist if he wants to appraise the project which requires venture capital funding. Number 1, the brief history of the company and its associated companies. Number 2, the complete information regarding the promoters of the company and also their role and responsibility. If the promoters are already running an existing company, then the track record of the promoters and the performance of the company in the immediately preceding 3 years and the expected earnings of the company in the current year. The total finance required for the project and means of financing the project. Projected financial statements of this project for the 5 years and also the flow of funds. Technology to be used in the project and also the statement indicating the extent of innovation used in the project. A complete analysis of the market regarding demand and supply as well as the impact of competition on the price fixation of the product manufactured by the project. Details showing all approvals and clearances from various statutory authorities and government. Methods of effluent and waste treatment. Details of utilities. Schedule for the implementation of the project. Factors to be considered by a venture capitalist before financing. Before financing any project, a venture capital fund should consider the following factors. And if these things are right, only then they should venture ahead in financing that project. These factors are as follows. Nature of product or service manufactured or provided by the undertaking. The level of expertise in manufacturing of product or service. The level of competition likely to be faced by the venture capital undertaking being financed. The likely future prospects of the product or service. The expertise of management in running the undertaking. The level of risk borne by the entrepreneur himself. Skills and characteristics of successful venture capitalist. The Institute of New Enterprises Development, INED, in Belmont, Massachusetts, USA, has identified many key characteristics and necessary skills required to be a successful entrepreneur from the point of view of venture capital investment. These are as follows. Number 1, drive and energy level, which means the entrepreneur has the ability to work for long hours. 2, self-confidence. This is the ability to believe in self and the faith that the goals will be achieved. 3, long-term involvement. A complete commitment to work for 5 to 7 years and to work towards distant goals. 4, using money as a performance measure. Money in the form of salary or capital gains or profit should be viewed as a measure of performance, not an end in itself. Number 5, persistence, problem solving, an intense and determined desire to complete a task or solve a problem. Number 6, setting challenging but realistic goals. Ability to set clear goals and objectives that are challenging yet realistic and attainable. Number 7, taking moderate risk. Taking moderate calculated risk which provide a reasonable and challenging chance of success. Number 8, learning from failure. Ability to use failures as learning experiences and to understand the causes of the failures so that similar problems could be avoided in future. Number 9, using criticism. Ability and capacity to seek and use criticism. This can serve as a base for improvement in the future and corrective action can be taken. Number 10, taking initiative and seeking personal responsibility. The ability to take initiative and seek leadership roles. Number 11, making good use of resources. Ability to identify and use expertise and assistance that are relevant to the accomplishment of goals. Number 12, competing against self-imposed standards. Establishing own realistic standards of performance and then competing against them. Venture capital funding has gained tremendous momentum over the past few years. The concept came into picture in the year 1986-87. The venture capital corporation can be in the form of the fund or a company. The funds include TDICI, CanBank and Indus, while the companies include TCBC and CCBC, etc. The following are some of the prominent venture capital companies and funds in India: Technology Development and Information Company of India, TDICI, Risk Capital and Technology Finance Corporation, RCTFC. The main reason for venture capital fund was to provide finance to even those areas which are not proven, which can use new technology to manufacture a new product or at times can be risky. The traditional financing by commercial banks and financial institutions is always an area where there is safe technology. The venture capitalists provide finance either in the form of debt or in the form of equity. The debt can further be in the form of conventional loans or maybe in the form of conditional loan. Once the project is successful and with time it starts generating normal returns, the venture capitalists seek an exit route. Venture capital investment process is a sequential process which involves 6 basic steps, which are deal origination, preliminary screening, due diligence process, structuring the deal, managing the investment and other related activities, exit. Before financing any project, a venture capital fund should consider certain factors, and if these things are right, only then they should venture ahead in financing that project. The Institute of New Enterprises Development, INED, in Belmont, Massachusetts, USA, has identified many key characteristics and necessary skills required to be a successful entrepreneur from the point of view of venture capital investment.